We're live. Uh, my name is Zane Stevens. I'm the founder of Protea Financial, and I come today a little bit under the weather, so my brain might not be working at its regular pace. Bit of a head cold. The joys of having young children, and they bring home all sorts of germs from school. So we're going to try our best today to get through this. Try be as clear and concise as I can be. And today I want to talk about a very important topic, which I sort of brought to the forefront last week, but I wanted to spend some more time on it this week, and that is gross margin. What is gross margin? And if I ask a business owner that, I'm sure that they will all have a general sense of what it is, but there's a very good chance that they sort of know what it is for their products they're selling, maybe not. And yes, this is a live episode that is mostly focused on product companies, people who manufacture products. And that's important, obviously, because that's what we do, right? We service the wine industry, the alcohol beverage space, where they are manufacturing a product. Yeah. People don't like to hear that wine is manufactured, but that's what it is, right? You're taking a raw material, you're putting it through a process to create a finished product. Well, that's the same as manufacturing. So we're going to touch on sort of understanding what gross margin is. And at a high level, gross margin is the amount of profit you have per unit when you sell one of your products. So it's the point of, if I sell a product for $10, how much of that $10 is profit before taking into account any overheads I need to incur to run my business. So we're really just focusing on the direct costs related to that product. If you're buying that product, it could be as simple as the list price that you pay for it. I'm buying widgets at $5 a unit, and I'm selling it for $10 a unit. My gross margin then is $10 less the $5, and that gives me the total price. It could get a little bit more complicated that you are buying widgets, but you're actually buying those widgets from overseas, and thus you have a shipping cost, plus you have clearing cost and excise costs. So there you could be buying the product for $3, your shipping is $1, your taxes are $1. Again, you come to the $5 cost, but it's made up a little bit differently. You still have the same gross margin, because then you're taking the $10 less the 3 less the 1 less the 1 gives you $5 gross margin. In a manufacturing process, it gets a little bit more complicated to understand what your cost of goods are, because you have to account for more things. You have to understand, if I take these pieces and I turn them into a finished product, I need to understand the costs from those pieces to the cost to make them into something finished, and then have a product that's finalized and able to sell out. So there's a few things within that process that you need to think about to totally figure out what your cost of that product is. And once you know the cost of your product, then you have an idea what your gross margin is. So if we dive into it, there's a few very key elements when coming to understanding what the cost of that product is. And we've touched on a few of them, because if you're buying a widget, it's fairly simple, right? There's the cost of the actual product, which you'd in a manufacturing process would be your cost of your direct materials. So if you're thinking about, okay, instead of purchasing that widget, I'm now having to build that widget, it would be like component A, component B, and component C. Each of those components have a cost, and I would need to add the cost of those components together to get me the total cost of my direct materials. Most of the time, it's a little bit more complicated than that, because you're going to have shrinkage, breakage, those types of things. Those need to be considered. Um, if I think about, if I'm manufacturing wine, not all your bulk wine. You're going to crush your grapes, and you're going to get, 10,000 gallons of wine. Well, you're probably not going to get 10,000 gallons of complete products, because there's going to be some evaporation, there's going to be some spillage, and then when you get to the bottling process, you're going to lose some of that wine as well. So you need to take into account your breakages and spillages and all those things, pieces that don't get used within your direct materials as well. This also could come into account if you're talking about, labels or boxes where you have a minimum order quantity. You have to account for all those minimum order quantities. So if you're manufacturing 9,500, but your minimum order quantity was 10,000, and there's nothing you can do with those 500 boxes, well, your price then is, instead of taking the total price of that invoice, dividing by 10,000 times by 9,500, you're now just taking it divided by 9,500, and each individual unit is slightly more expensive, and that should be allocated to direct materials. It gets a little bit complicated, but this is why we talk about getting an accountant, somebody that has the expertise and can help you with it. Some of the other things that you need to consider, and we sort of mentioned is there's going to be some freight or some shipping costs to maybe get those products. Your vineyard and your manufacturing and your winery might be in two different locations, so you have to pay a truck to carry those grapes to your facility. Well, that's a cost involved, and that cost should be included within the product. Same as if you're bringing in components like glass, you've got a cost to actually ship them to your warehouse. They might also be imported, which would include some custom duties or taxes. That would be included in the total cost of it. You wouldn't expense that portion of it. You would include it in the cost of the glass and work out what that total cost is per unit. The two that I think where most business owners get stuck up and sort of forget about, a lot of people really understand their direct materials and understand that there's a cost to get those direct materials, and they understand that that's a cost of their product that they sell. But two of the things that get forgotten a lot of the time, specifically when there's a manufacturing process, is both direct labor and direct overheads, or your manufacturing overheads. So labor can be tricky, especially if you have variable manufacturing quantities. So if you have people working in your winery, well, the cost of their labor, specifically if all they're involved in is the manufacture of that wine, they're a winemaker, for instance, well, their salary has to be allocated on a monthly basis. Gets a little bit complicated. Effectively, what you're doing is saying, hey, I paid them, just for ease's sake, we paid them $5,000 a month, right? And we're manufacturing 50,000 gallons. Well, then you'd go 5,000 divided by the 50,000, and you would allocate that cost per gallon to the gallon of wine to make sure you're incorporating your direct labor on a monthly basis. And that would be including every person along the way. So especially if you have your own vineyard and you're harvesting, well, that harvest labor needs to be included in the cost of your grapes, and those need to be capitalized at that point in time and shouldn't be forgotten. Same with manufacturing overheads. Now, manufacturing overheads can be a little bit complicated, specifically because a lot of them are actually going to be capital expenditure, right? You bought a tank, you bought a bottling line, you bought all these components. Well, there's depreciation on them, right? So that depreciation should be included in the cost of your manufacturing. Another one that you could think about is like, hey, I'm renting a facility or I'm paying a mortgage on a facility. That cost of the rent of the mortgage would also need to be included within the cost of that manufacturing process. Manufacturing overheads can be really tricky. Most of the time there needs to be some sort of allocation that needs to be done. I'm paying for the facility, but only 60% of that rent is accounted towards the actual manufacturing facility, and 40% of it relates to the admin side. Well, we only want to include, the 60%. So whenever you're thinking about manufacturing overheads, you've got to be thinking about, your rent, your utilities, your depreciation, your maintenance, and then any other related costs to run that facility. Becomes a little bit more complicated, and this comes to the point, like gross margin. Do you actually know what your gross margin is? I've just gone through really quickly and really simply that there's way more to understanding the cost per unit than just going, okay, that's what I paid for it. Now, it could be in your business that it is that simple, but you'd probably need to take a little bit more into it. Then there's some even other costs, which are some of your direct selling costs that you can allocate to your cost of goods as well. Like, hey, what happens if I only sell DTC and I have to pay a credit card fee on every transaction? Well, that credit card fee is part of your cost of goods sold. Are you considering for every item that I'm selling that I'm losing 3% of my revenue? You understand that comes straight out of your gross margin and affects your bottom line. So there's a lot more to understanding what gross margin is other than just, I know what the cost of my direct materials are. This is why we always recommend get yourself an accountant that knows your industry, specifically when you have complex costing of manufacturing products. Understanding your cost of goods is really critical to be successful in a business, because if you don't understand what your gross margin is per unit, you're never really going to understand how many units you need to sell to break even. And as we spoke about last week, if you don't really understand those numbers, how are you ever going to get cash flow positive? You'll just consistently be stuck with with cash tied up in your working capital, i.e., your inventory. So understanding your cost of goods sold is really important. So what is gross margin? Gross margin is the profit per unit of items sold before taking into account the overheads to run your business. So it is purely what is the cost of that product that I sold. Now, that is not as simple as just a single unit direct material. If you're manufacturing, you need to think about it a little bit further, and you need to take into account your direct materials. That's the cost of the raw materials or components used in the production process. Number two, you got to focus in on direct labor. This is the cost of wages, benefits, and payroll taxes for the employees directly involved in the manufacturing or producing of the goods. You need to consider your manufacturing overheads, the indirect costs incurred during the production process, which includes rent, utilities, depreciation, maintenance, and any other expenses that you need to run that facility. You also have to think about freight and shipping, the cost of transporting a goods from a supplier to manufacturer. So specifically, if your vineyard is separate from your winery, you might have to cost to truck those grapes across. And then if you're importing any of your components, don't forget about the custom duties and import taxes available there as well. That should also be capitalized. Cost of goods sold in a manufacturing process is very much more complicated than this is what it cost me. You need to take into account the costs to convert raw materials into a finished product. If you're a small business owner and you're busy running a business where you sell inventory, it's very important to get help from a professional, somebody that understands your industry and has some sort of background in costing your inventory. Because that step right there of costing your inventory and truly understanding what the cost per unit is the difference between success and failure. Because if you don't understand how much you're making per unit, there is no ways you can know how much you need to sell, and you'll never understand what the break even of your business is. Focus in on that cost per unit, understand it, set your prices accordingly, and hopefully you'll be profitable. And a profitable business should lead to a cash flow positive business, as long as you're not having to spend too much on capital expenditure. Gross margin is key to the success of your business. Make sure you know what it is. Until next time.